Hello everyone, and welcome back to the Mortgage Rundown. Today we're going to talk about what's happening with interest rates. As a lot of you may have noticed, mortgage rates have been coming down for the past several months, despite the fact the Fed continues to raise their benchmark rate. They've raised it 0.25% in December, 0.25% in March, and 0.25% in June. That's 0.75% in rate increases in 6 months. However, since December, the 2-year Treasury is up only 17 basis points, and the 10-year is actually down 25 basis points. So how is it that the Fed is raising rates, but Treasury rates aren't moving up as much? And more importantly, why are mortgage rates going down? Take a look at the graph on your screen. This is the spread between the 2-year Treasury and the 10-year Treasury, often referred to as the shape of the yield curve. As you can see, the spread is compressing to near the lows of the last 8 years. Traders often use the shape of the yield curve to project the path of interest rates going forward. When the shape of the curve goes negative, that's been a relatively good indicator of a recession upcoming. The first thing to note is that the Fed wants to raise interest rates. Make no mistake about that. They want to preserve accommodation for a time down the road when they may need more economic stimulus. But they also need to be careful because inflation is looking weaker and weaker, and the market only prices in a 50% chance of one more interest rate raise this year. Another observation worth noting is that the Fed is relying on a belief that because the unemployment rate is so low, that eventually wages will rise and bring inflation along with it. I would say that is a very controversial opinion at this point. All other inflation indicators such as food, commodities, and so forth are trending towards zero inflation and possibly deflation. So if the Fed is right, then expect the long end of the curve to rise and with it mortgage rates. This may be a great time to lock your mortgage rate. In fact, historically, it's a great time to lock in a fixed rate mortgage when the yield curve is flat. However, if they are wrong and long-term rates drop, then the yield curve could invert and recessionary fears will plague the market. In the coming weeks, you should keep an eye on the following items. Number 1, Friday brings the Fed's preferred inflation measurement of PCE, that's personal consumption expenditures. 2, the Fed's June meeting minutes will become available on the 5th. Perhaps it might shed some light on the discussion topics between Fed members behind closed doors. And last but not least, we start a new month, so don't forget payroll data and the unemployment rate will be available on Friday the 7th. If you'd like a more in-depth analysis, please visit our blog. You can find the description below. Thanks for watching and have a great day.